Okay, welcome to section 8.8 on credit cards, another really important topic in finance. Credit cards are an example of an open-end installment. Unlike the loans that we were dealing with for cars and homes that have fixed monthly payments, credit cards typically have a minimum monthly payment that is calculated based on what is charged to the card and not a specific amount that is set for every month. And with a home or car loan, you pay that amount no matter what. But with a credit card, you only have a payment due if you have made purchases. So this is also called a revolving credit as well. So I'm not going to read all of the information to you that is in this slide or in the presentation at large. There are pieces that I'm just going to paraphrase for you. There are points that I'll highlight, and then there are some examples that will work out together. So you are billed every month, and you receive a monthly statement with all of the items that you have purchased listed with the amounts that they were. And then it gives you the amount of interest, any charges or fees, and it doesn't clearly spell out the calculations that were made in order to determine your final payment due, but it is in the fine print how it is calculated. A lot of the credit cards have the same type of average daily balance calculation that is used to determine payments. So we'll look at how that works in this presentation. If you are feeling like you already know all of this information, well, you very well may, but there might be a few points within the presentation that are new for you. So I would recommend at least scanning through and seeing if you do already understand everything. If you can go through the PowerPoint by yourself, then by all means do that, but give it a chance to actually learn one or two new things, even if you are pretty familiar with credit cards and how they work. So interest on credit cards, like I mentioned before, is often calculated by taking the average daily balance. And this is only one of the methods that credit card companies will use. So you will have to check the fine print of your credit card to determine whether this is what they use or one of the other methods. So the interest is calculated using the simple interest formula, I equals PRT, and the average daily balance is exactly what it seems. So in determining the average daily balance, you follow these 5 steps, and you can calculate it. Make a table that shows the beginning date of the billing period, each transaction date, and the unpaid balance for each date. Well, the nice thing is if you have the itemized billing statement, then you don't have to create this table. The statement gives it to you. Otherwise, a lot of credit card companies have nice websites that you can view your account, and all of this information is laid out pretty nicely for you. Step 2, add a column to the table that shows the number of days at each unpaid balance. If you're going to find the sum of the unpaid balances, then you need to know if I made a charge at the beginning of that $50 and it remained at $50 for the first 5 days, then I'm going to have to add up the 50 5 times. So I need to keep track of how many 50s I have. So if you're not going to list out every single day in the period, then you're going to need to multiply by how many days you were at that balance. Step 3, add a final column to the table that shows each unpaid balance multiplied by the number of days. All of this is just to find that sum of the unpaid balances, which step 4, we finally add them all up. And then step 5, divide by the number of days in the billing period to find the average. So an example. The issuer of a particular Visa card calculates interest using the average daily balance method. The monthly interest rate is 1.3% of the average daily balance. The following transactions occur during the May 1st to May 31st billing period. So they give us here the itemized billing statement, and it doesn't give us the total balance for every single day. It just gives us when a transaction occurred. Okay. A, we need to find the average daily balance for the billing period. Okay, so let's go back up. The previous balance was $1,350. So at the beginning of the month, that is the unpaid balance. So from May 1st to May 8th, when the next transaction occurred, it was $1,350 for those first 7 days. So we have this $1,350 times 7 days. After that May 8th transaction, there was a $250 credit. So that $1,350 that was owed, well, now it's brought down to $1,100 that is owed because of the $250 credit that was put towards the account. So on May 8th, it goes down to $1,100, and it doesn't change until May 10th. So $1,100 is the balance for the 8th and 9th, so 2 days. At that point, airline tickets are charged, so that's $375. Then the balance goes up to $1,475. And it is $1,475 from May 10th to May 19th, which is 10 days. Because then on the 20th, we have a new transaction, $57.50. When we add that, the new balance becomes $1,532.50. And it is at $1,532.50 from the 20th until the 28th charge. So from May 20th to the 27th is 8 days. And if you are having trouble seeing why it's 8 days, you think to yourself, the 20th to the 27th. You might think that that is 7 days, but in fact, if you count from 0 to 7, since the 0 counts there, it's not just 1 to 7, which is 7 days. It adds the 20th as well. So you would think to yourself, the 21st to the 27th is 7 days. So the 20th to the 27th must be 8. That's how I think about these myself. If you have a different way, then awesome. Okay, so then on the 28th, there is a charge for $65.30, which brings the total up to $1,597.80, and that $1,597.80 goes from the 28th to the 31st. So 28 to 31, which is 4 days. You think to yourself, 31 minus 28 is 3, but that subtracts off the 28, so we have to add 1. It is 4 days. Or since it's only 4, you can just add them or count them. 28 is 1, 29 makes 2, 30 makes 3, and 31 is the 4th. So then we have those unpaid balances for that many days. So if we add up the number of days off to the side that I have multiplied these by, this should account for the entire billing period, which was the 1st to the 31st. So it should be 31 days total. And if you add those up, it does get you 31. Okay, so now we need to go ahead and multiply those and then add them. So I'm going to go ahead and get some more space. All right. Let's erase all of this that we no longer need. So in the calculator, I would go ahead and multiply each of those. And I have that worked out right here. The 1350 times 7, 1100 times 2, 1475 times 0, the 1532.50 times 8 gets me 12,260. And the last product is 6391.20. The products, next step is add them all up. Because all I'm really doing is adding all 31 unpaid balances. But writing out all 31 of them is going to be much more work, time consuming, harder to keep track of, I think. So instead, it's nicer to set up these multiplications, work them out, and then add up those instead of adding all 31 up together. If you prefer the other way, then okay, by all means, but we'll do it this way. So when I add all of those up, I get $45,051.20. But the average daily balance takes the sum of those and divides by the number of days, which we had already said was 31. So when I divide that by 31, it gives us 1,453 to the nearest cent, 0.26. And that is our final answer. That is the average of the unpaid balances. So this is going to be used to find the interest rate and determine our bill. Okay, so next step, part B. Find the interest to be paid on June 1st, the next billing date, round to the nearest cent. So we use simple interest, and we know that the principal, the amount that was lent, the average daily balance that is, was $1,453.26. The rate, it gave us 1.3%. So we'll change that to a decimal. And the time, it's always going to be a month. Interest is calculated monthly for monthly statements. So 1 month. And when you plug that into your calculator, it gets us to the nearest cent, $18.89. So that is our interest. Find the balance due on June 1st. That is the unpaid balance on May 31st plus the interest. Okay, so the balance on May 31st, that last unpaid balance was $1,597.80. That is the end balance of for May. So you always need to keep track of where does it end for the month, because that determines what the balance is at the beginning of the next month when it starts to roll over. So it starts at $1,597.80, but then they add the interest, which we got $18.89, and that gives us $1,616.69. So on June 1st, that is the unpaid balance at which the month begins. So this credit card requires a $10 minimum monthly payment if the balance due at the end of the billing period is less than $360. Otherwise, so since the balance due at the end of the billing period is not less than $360 for this problem, we cannot just pay the $10 minimum. Instead, we're going to have to see what they say otherwise. So otherwise, the minimum monthly payment is 1/36 of the balance due at the end of the billing period, rounded up to the nearest whole dollar. So what is the minimum monthly payment due by June 9th? And by June 9th is just May's bill. So we need to find out what is 1/36 of And the balance due at the end includes the interest. So it is $1,616.69. Of means to multiply. So we plug this into our calculator, 136 times 1616.69, and it gets us rounded to the nearest whole dollar, 45. So the minimum monthly payment would be $45. Of course, if you have a balance of $1,600 and you're only paying the minimum 45, the interest included in that $1,600 was already about $19. So you're really only paying for about $25 of the actual charges that are on the card, and you're basically just paying the amount of interest. So this is never going to be paid off this way. The interest is going to keep on accumulating, and your minimum monthly payments, you're going to be paying mostly interest and then a little bit of the bill. This is a terrible way of paying off a card. So just some advantages and disadvantages. There are good reasons to have credit cards, even though they are charging you interest. So you can obviously get products before actually paying for them. So if you have emergencies, or if you don't have the cash free, but you have it available, but just not on you or accessible at the moment, it's a good way to pay for items. The second one is one of the most important. No interest charges by paying the balance due at the end of each billing period. So if you pay the balance due at the end of each billing period, they don't calculate the interest because there is no balance due left. So that multiplication of 136, then they are, the interest, if it's I equals PRT, and the P is the amount owed on the loan, if that is zero, then you have 0 times the rate, whatever your rate is, times the 1 month. Well, that is going to get you 0. So if you have nothing left owed, then you're going to have no interest. It's a good way to build good credit, and I think those are really the most important ones. The next ones that are important on this slide, the second one is really important. Simple tasks like renting a car or booking a hotel room can sometimes be impossible without a credit card. A lot of those places demand a credit card in order to rent a car or get a hotel room. So it's nice to have those. If you are using them responsibly, paying off the balances, not getting behind, and paying for interest that rolls over and over and over month to month. You can also get amenities like free miles. My credit card gives points that I'm able to redeem for um, Amazon gift cards, and it's basically a percentage of what I spend that I get back free. If I were using cash, I would still be spending the same amount of money, but not getting a percentage back. So it's a free reward for using the credit card. Of course, there are negatives for using credit cards, and reasons that a lot of people uh, want to steer away from them and steer others away. One is that the interest rates are quite high on a lot of them. If you have unpaid balances, it can spiral out of control. In our example, the interest rate was 1.3%, but that's a very generous rate. Um, it's not uncommon to see rates as high as the 30%. Very common to see rates like 24.99%. So that's basically 1/4. So you're paying in interest 1/4 of the unpaid balance, which is crazy. If we recalculated the interest on our example problem with 25% interest rate, so we had owed $1,616, and we paid 25% interest rate for 1 month, then this in our calculator gets us 404, which this is a much more likely scenario than the 1.3%. So for most people who are unable to pay off their balance at the end of the billing cycle, they're going to be paying something like 25%, which clearly this is going to balloon out of control for a person who is unable to pay off a balance in the first place. The second item here, no cap on interest rates. So the credit card companies can include any kind of interest rate that they like. They could jack it as high as they want. The Senate has seen bills that would restrict it and keep it down to a reasonable level, but they said no, the credit card companies can set it to what they like, and you can agree to it or not agree to it. And if you sign up for a specific interest rate, it can go up later. So you want to reassess if the credit card company does change your rate. Also, there are all kinds of fees that can be placed on a credit card. Annual fees, monthly service fees. You need to really read the fine print of your credit card. Not all of them include things like this, but some do. They will give you a better interest rate, but the amount that you pay in these fees, it offsets. So you really need to know what it is you're signing up for. Beyond items like that, it's easy to overspend for some people. They don't use it just for what they could afford. They use it for items that are splurges that I couldn't really pay cash for this, and I don't see a way of saving up to pay this off quickly. but I'm going to use it anyway. Sometimes that's unavoidable for things like emergencies, but in other cases, it's just a terrible financial decision to make. So the next items, the last one I already hinted at, the minimum payment trap. If you're making the minimum payments, then they're going to continue adding the interest. And if your interest rate is more like 25% than 1.3%, that's going to get you into a lot of trouble. Debit cards are connected to your actual bank account. So it doesn't have the interest concerns. It's not something that you're paying in advance. It is actually deducting from your account. So it doesn't have most of the concerns that a credit card does. But the one that it has is it can still be tempting to spend in ways that you would not with cash. And that can cause fees like overdrafts. So it's a good idea to have overdraft protection in case you have lost track, which I highly recommend that you never lose track of what's in your account. You keep track of that, and you won't have to worry about the fees that will come from going over your balance and putting your account into the negative, because you get a fee for going over, then you get a fee for every day that you're over, and pretty soon your account that you could have had overdraft protection and not gone over, pretty soon it is hundreds of dollars in the negative because you went a little over, and then you might not have been able to take care of it or whatever. It slowly adds up. Okay. Obviously, debit cards, you can access your money through ATM. So it would be nice to have one of those and not need to go to the physical bank, especially in times of quarantine. The next item in this section is credit reports and credit scores, which I briefly mentioned in connection to the credit card. You may or may not have a credit history established already, but if you get your credit card, your first credit card will initiate your credit report. And the first time you take out a loan or really any major financial transaction that you complete will immediately begin a credit report, and you'll start accumulating a credit history. In your credit report will include things like all of your credit accounts, all of your loans, your payments, your balances, your payment history. Have you paid on time? Do you owe too much money? Sometimes places of business will use your credit report to determine whether to do business with you. Can you be trusted financially? They'll use your credit report to determine that. Sometimes housing will use a credit report to determine whether to rent to you. So it's really important that you establish a good credit history, and if you have issues with it, that you take care of them so that it doesn't come back to haunt you later If you want to get a home loan or a car loan, they'll definitely be looking at your credit history, and you don't want to plan for the future and then have a bad credit report prevent you from those dreams. Any public records like bankruptcy will appear on the credit report. If any of your accounts have gone to collections, even though that is not a current account for you, that will still show up on your credit report. And so all of these places that are investigating you to determine your credit worthiness will see that. And also inquiries like how many times people have accessed your credit report. So are you trying over and over and over to get credit cards and loans? They'll see how many times your credit report has been accessed as well. The three main credit bureaus have your credit report, and each one is slightly different. Sometimes something will show up on one and not the other. So it's a good idea to access all three of them and make sure that your information is correct. And it gives you a good way of trying to correct any concerns, or maybe there is something on your credit report that doesn't belong. So I recommend that if you haven't, go to the website annualcreditreport.com and get your free annual credit report. You get one a year free from the main bureaus. So why not do it if you haven't done that yet? The credit scores themselves. So you get a credit score that takes into account all of the information in your report, and they rank you from 300 to 850. And a lot of businesses will use that score as a quick indicator of your credit worthiness. And as you can see in the table, 300 to 579 is considered bad, and then it goes up from there. You want to be obviously in the 720 to 850 range. The higher your score, the more likely you are to get good rates and to be accepted for various programs and to be rented to. So it is a good idea to have the highest credit score that you can obtain. That is everything that we have in this section. So if you have any remaining concerns about the average daily balance method, please feel free to email me. We could set up Zoom. I could do another example. Just let me know. Have a good day until then.